manage risk in the organization, right? That it is, linked somehow to strategy, and that there's a certain risk appetite that's linked to those strategies, all right, and to the organization. So it communicates the intent of the, of the organization, of the senior management, and that's why the policy itself is really important, right? And there is something that needs to be done as an intent of senior management, right? And the risk management policy basically answers questions like, how willing are you to take risks? What's the guideline, right? What's the risk appetite within the organization? I think that is very important. One of the organizations that I work with told me that the risk appetite to them was a starting point about thinking about risk. Because if they know that the senior management is prepared to take certain risks, they look at it and say that, if we are prepared to take, let's say, up to about, in Singapore dollar term, 100,000 in terms of operational losses, right, on this particular area, why do we need so many controls? Why do we need so many check and balances in this process? Because this process, even if it goes disastrously wrong, right, it can only incur a loss of 50,000 Singapore dollars. So heck, why don't we just, take away some of the controls, make our processes more efficient? Therefore, we are able to better compete in the marketplace. So that's one way about thinking about risk. That actually, once you set your risk appetite, it's not about putting more and more controls in. It's also about thinking about whether you have over-engineered your business process to be over-controlled. Because if you think about it, after you've done the risk impact, you say, even if there's no control, inherently the risk is only this exposure, right? I don't worry about it. It's like in personal life, right? We don't need to buy insurance if you are able to self-insure. We are able to stand that risk, we don't need to buy insurance. So that is the reason why the risk appetite is a very important parameter in risk management, right? So the risk policy answers questions like, how willing are you to take risks, right? What are the types of decisions, right, that needs to be made in terms of risk management, and who's to make them in terms of strategic decisions, operational decisions, project decisions, all right? Okay, so basically, when we think about risk, okay, I always advise my client that risk is at several levels, and you need to think about risk at 4 levels, all right? And most people, because most of the time they start off with the operational level, right? And they start to identify risk at the operational level. It's very, very boring. It's probably not very productive, because most of the risks you can think about doesn't really impact the organization that much, right? But when you talk about risk, that's what people talk about. But actually, risk can be, talked about or discussed at 4 levels, and each level got a different language. You can talk about risk at a strategic level, where we talk about when you do corporate planning, when you talk about organization level risk, right? Correct? You talk at that strategic level. But your strategy will also spawn off some major programs that you need to do. Maybe it's a BPR program. It could be an outsourcing program. It could be a program to expand overseas. So there will be program risk. Each of these programs will have multiple projects, right? So there'll be project risk within the program. And lastly, obviously, are the operational risks that we are so familiar with. So each of this level has a different set of language to talk about risk, and a different audience for risk. And that is a very important point that needs to be taken into account when you talk about risk in the organization. Because if you ask the CEO to talk about operational risk, he definitely will not be very engaged. Whereas you ask operation manager to talk about strategic risk, right, correct, he's lost. It's not that he doesn't want to contribute, but he really is lost. All right? But risk management needs to be embedded throughout the organization, and therefore, as you go down the organization, you've got to select the right level of risk to talk to that particular level of management. Right? Okay, this is the risk management processes which I talked about just now, all right, which is the risk identification and the management of risk, right? And I talked about the risk culture already, looking at risk as uncertainties rather than just as on the downside. I talked about the risk identification and the evaluation as well, right? The risk tolerance, the risk appetite. I say risk appetite can actually be used to make sure that, you actually look at areas, especially the operational areas where you have maybe over-engineered your controls. right? And then you may be able to actually improve the efficiency of your organization. But there are also, the risk appetite will also show you areas where the board of directors say it's a big no-no, regardless of how much profit you're going to make. For example, there's a case in Singapore in year 2007. I'm not too sure you heard of China Aviation Oil, which basically had a big fraud, in a big disaster in their trading. They engaged in oil trading, oil futures trading, and they lost something like 600 million Singapore dollars. All right. But actually, the reason why China Aviation Oil is set up in the first place was actually a very simple enterprise. They are to buy aviation oil from the global market and then mark up by a certain margin and sell it to all the airports in China. That's their only reason for being in existence. All right. The reason why they went into oil futures trading was only to hedge against the price of oil, so that in case they buy at high price, by the time they deliver the oil to the customer and the price of oil has dropped or whatever, they're at least protected. It's only an insurance policy. But during the 05-06 years, they found that actually this is so profitable, right? That actually, without consent from the board of directors, without anybody knowing, the chief trader and the CEO basically went into speculative trading on oil futures. And because of that, right, when the market tanked, they lost $600 million. We were engaged later as an advisor to help them to improve their internal controls and the risk management, right? And one of the things they put in was that they identify risks that will be avoided at all costs, regardless of the profit margin. Okay, right? And one of the risks was speculation in oil trading, because it's not their core competency, right? But that illustrates a temptation for senior management. If your incentive is very much linked to the profit for that year, right? And you find that actually if you do some forex trading, because you need to hedge your overseas exposure, but while hedging your overseas exposure, you find that actually that contributes to the bulk of your this year's profit, and your operational profit, is not that much. That becomes so much more sexy, right? And therefore you begin to, hey, why don't I try to make more profit on the side here so that I can compensate for this very, very low margin on my normal business, right? And risk management helps you to say that, is it a permissible activity? Are you permitted to go and do trading on Forex? Even if you know for sure you will definitely, win the bet and get a huge profit for your organization, right? Is this a risk that you can take? And the risk tolerance will be set by the board of directors to say, yes, you can do it with the permission of the board of directors upon a careful evaluation, or no, it's not our core business, we ain't going to do it. All right? And that is the importance of risk tolerance. Okay. Very quickly on the ending part, I just want to share with you some of the tools that we use with our client. One of the tools that we use to understand risk is the value map, which I think my colleague Louis will talk more about. Together with the value map, we have a map called the risk intelligence map, which helps us to understand the various risk factors. Like I said, we've got about 600 risk factors, but they are meant not to be, not to be used all at once. They are really meant to help us to... okay, this is another technology risk. Okay, anyway, I'm towards the end of my presentation. Right. It's really meant for us to have a conversation with our client, right? To really promote critical thought leadership critical thought over the overall risk exposure. And the key word here is critical thought. We always emphasize that our client think carefully, critically, and analyze carefully the risk factors. And the tools that we use here is to explore how various risks interact with each other, the impact of those risks, identify potential risk interaction, and to go through a conversation with you about risk. It's not meant as a pure checklist to just tick, and say, yeah, this is the 100 risks we are exposed to, right? And therefore, let's go and come up with a program to manage 100 risks. It's meant to talk through all those risks so that you can come up with the top 10, top 15 risks. And then after that, we can think about what to do about those risks. Okay, so that is some of the tools and techniques that we use in terms of risk management. And with that, I will end my presentation. As for the Q&A, I think we have it later, right? Is it,
Yes.
Richard? Okay, right.
Very good.
All right.
And just while we're getting set up, I'll just mention there was a couple of requests for personal meetings with the Deloitte people, and there might be some things that you don't want to discuss in an open forum, and you can have a private meeting. There are a number of their regional people here. We have Alec Korlikov here. We have Gancham here, also from the region. So if you are interested, they'll be here for the day, and I hope I'm not saying this wrong, but I think they'll have some time to arrange meetings. There's another organization that has requested. But I'll welcome Louis Manabat. He is the managing partner of the Deloitte affiliate here in Philippines. He's a certified public accountant as well as a lawyer, and a member of the board of directors of the Deloitte Southeast Asia group. So please, I'll welcome Louise Manabat. Thank you.
Thank you very much. Actually, I'm now going to go into the portion where risk management impacts growth. As a CEO, one of the key roles that I have to fulfill is make sure that the firm grows. However, there are times when you think that risk management and growth seems to be antithetical to each other, which should not be the case. We are going to be planning on how to grow on a risk-adverse environment. Just a snapshot to give you an idea of where we operate. During 2010, this is a table showing the GDP growth of the Philippines and Southeast Asia. While we are not really on a large amount, you would see that across the region, Asia Pacific and Australia is actually one of the largest. The business trends on a regional view, the Southeast Asia is actually recovering from financial crisis, and there is increased interest in the area or the region where investment seems to be growing. Okay. However, there seems to be increased regulations as well as government monitoring brought about by some of the incidents which have happened in the global economy in the past. For the Philippines, generally it's a positive outlook, but people are still in a wait-and-see mode simply because there seems to be a clamor in order to improve the business climate. Still, there seems to be registering a positive growth. Okay. So again, the forecast until 2014, Asia and Australia seems to be getting a fair amount of interest, at least until 2014. Okay, trends in the community. Businesses are actually going into either of two or a combination of the two approaches. The conservative approach is to try and consolidate your gains, try to protect your interests, okay, increase governance structure, and then go on a more internally focused organization. The more aggressive ones tend to expand and diversify the businesses. In fact, in the Philippines, you start seeing companies veering away from their core competencies and expanding into other businesses. Okay. However, it also means that they have to increase governance because you expose yourself to more risks. Okay. So again, governance structure is important. Then those who are more aggressive tends to focus externally. If we cannot grow the business from within, then we start acquiring businesses outside our business. So planning for growth. How do you plan for growth? First of all, you have to have some realizations in the risk environment. Okay? One, the presence of risk doesn't necessarily mean that there are no growth opportunities. On the contrary, there are actually a lot of growth opportunity in a risk environment. Okay? Now, in the light of heightened risk and government monitoring, the tendency